What's up, investors? Iggy the Investing Iguana here. In today's video, I'm going to break down 3 Singapore stocks that could be seriously undervalued right now according to the analysis gurus over at Simply Wall Street. We're talking potential discounts of over 30% to their estimated fair values. But it's not just the numbers that have caught my eye. These 3 companies, Seatrium, Frasers Logistics, and AMP, Commercial Trust, and Nanofilm Technologies, operate in really interesting industries like offshore engineering, industrial REITs, and nanotechnology. So stick around, because I'll be simplifying all the key points and financials to help you decide if these could be value plays worth considering for your portfolio in 2024. Let's get started. Seatrium Limited, SGX, 5 times 10 squared. Let's kick things off with Seatrium Limited, a big player in the offshore, marine, and energy engineering solutions space. With a market cap of around $5.69 billion Singapore dollars, Seatrium is no small fry. Their revenues come from areas like building rigs and floaters, doing repairs and upgrades on existing structures, constructing offshore platforms, and even specialized shipbuilding projects. Now here's where it gets really interesting. Simply Wall Street, those smart analysts over there, reckon Seatrium's shares could actually be worth $2.44 each based on their calculations. But get this, the stock is currently trading at just $1.67. That means it could potentially be undervalued by a massive 31.7% according to their estimates. And the upside could be even crazier, with some analysts seeing nearly 70% potential gains from current levels if their price targets play out. A few other key points to highlight on Seatrium. They're forecasting annual revenue growth of 8.8%, which outpaces the overall Singapore market. The company is also expected to turn profitable within the next 3 years after some lean times. And the real kicker? Analysts see Seatrium's earnings growing by a whopping 72% per year going forward once they hit their stride. The only potential downer is their projected return on equity looks a bit low at 8.1% in 3 years' time. Next up, we've got Frasers Logistics and AMP, Commercial Trust, a major real estate investment trust or REITs dealing in industrial and commercial properties. And when I say major, I mean it. This REITs has a massive $6.4 billion portfolio spanning 107 properties across Australia, Europe, and key Asian markets. With a market cap of around $3.59 billion Singapore dollars, Frasers is a real heavyweight in the REIT space. Now here's where it gets really juicy. The number crunchers at Simply Wall Street reckon Frasers could actually be trading at a 41.1% discount to its estimated fair value of $1.62 per unit. Can you believe that? The trust is currently going for just 96 cents on the exchange. Imagine if you could scoop up shares at those levels and Frasers actually realizes its perceived fair value down the road. A few other key points to note about Frasers. They're forecasting annual revenue growth of around 6%, which beats out the overall Singapore market average. That's the good news. The potential downside is that Frasers seems to be carrying quite a bit of debt on its books, and its dividend payouts to unit holders have been a bit unstable historically. But get this, even with those concerns, analysts still see around 31.7% potential upside for the stock from current levels. Those are some pretty bullish expectations if they play out. Last but not least, we've got Nanofilm Technologies on our radar, a $507 million company operating in the cutting-edge nanotechnology space. These guys have their fingers in several pie across Singapore, China, Japan, and Vietnam through business segments like advanced materials and industrial equipment manufacturing. Now here's where it gets really fascinating. Simply Wall Street values Nanofilm's shares at a fair price of $1.35 each based on their analysis. But currently, the stock is trading at just 78 cents on the exchange. That's an implied discount of over 42% to their estimated fair value. Can you imagine scooping up shares at those levels if that valuation turns out to be accurate? A few other interesting points to note about Nanofilm. Their profit margins did take a hit recently, dropping from 18.5% all the way down to 1.8%. That's never a great sign. But here's the kicker, the company is forecasting a staggering 50.66% annual earnings growth rate going forward as they ramp things up. They've also recently declared a dividend of $0.0033 per share and given positive earnings guidance for fiscal 2024. So while the profit margin decline is a concern, it seems Nanofilm could have some strong growth and income potential brewing if they can execute on those lofty projections. At a potential 42% undervaluation, it's definitely a stock that has piqued my interest. There you have it, investors, my deep dive into Seatrium, Frasers Reits, and Nanofilm Technologies. 3 stocks that simply Wall Street's number crunchers believe could be trading at pretty hefty discounts right now. Of course, as always, this is just one perspective. You'll need to do your own research and decide if these businesses fit your investing strategy and risk appetite. But I hope I was able to simplify the key points in a way that gives you a solid starting point. If you found this video insightful, go ahead and smash that like button. And if you're new here, hit subscribe and ring the bell so you never miss my latest value investing analysis and insights. Until next time, investors, take it easy and don't forget the path to financial freedom starts with investing wisdom. Iggy out.